Welcome back to The Explainer. I'm absolutely thrilled you're joining us today because we are going to unpack a massive, highly complex system, see exactly how it works, and more importantly, how it completely falls apart. We're going to shatter one of the most famous financial myths of the 20th century to uncover a really critical, glaring blind spot in modern AI project management today in 2026. We're pulling all our insights straight from a fantastic historical analysis, case study CS052, which gives us incredible forensic detail on a failure that literally shaped the world. Get ready because we are drawing a direct line from Wall Street in the 90s right to your AI software stack today. Let's get into it. Okay, let's dive into this. $3.65 billion. I want you to picture this. It's an incredibly tense weekend. September 19, 1998. The Federal Reserve Bank of New York has locked the most senior executives from 14 of the world's largest banks in a single room, and they're essentially forcing them to orchestrate a rescue of exactly this dollar amount. They didn't want to do it, but, well, they had no choice. If they didn't come up with that $3.65 billion by Monday morning, a private hedge fund was going to collapse, and it was going to drag the entire global banking system down right along with it. So, the fund causing this massive global panic? Long-term capital management, or LTCM for short. Now listen, this wasn't some scrappy, reckless startup making wild bets. No way. This was the absolute dream team of risk management. It was founded by Myron Scholes and Robert Merton, guys who literally won the Nobel Prize in economics that very same year. And they were joined by Wall Street legends, folks like John Meriwether and David Mullins Jr. Mullins was actually a former vice chairman of the Federal Reserve. Their reputational credibility was just unmatched. And for a while, their models worked beautifully. I mean, look at those returns. 21%, 43%, 41%, and 17% over 4 straight years. Everyone thought they were invincible. So how on earth did this invincible team almost destroy global finance? Well, for decades, the official story has been the Black Swan myth. The narrative was that a completely unforeseeable, unprecedented market seizure just happened, like a random act of financial nature just swooped in and took down their brilliant, perfect models. It's a comforting story, right? The idea that sometimes, no matter how ridiculously smart you are, the universe just throws a curveball that nobody, and I mean nobody, could have possibly seen coming. And that whole unforeseeable narrative, it was heavily pushed by the founders themselves. Just look at how Myron Scholes framed the failure. He essentially claimed that the events fell so far outside their model's probability space that the model itself wasn't actually wrong, the world was wrong. It's kind of an incredible defense when you really think about it. It perfectly protected the institution's ego. And, frankly, the Federal Reserve kind of supported this framing too. Why? Because treating it like a freak natural disaster helped protect the broader financial system from a total, outright panic. Now, what's really interesting about this slide is that it gives us our first piece of real forensic evidence that completely dismantles that Black Swan myth. Nassim Nicholas Taleb points out in his 2001 book, Fooled by Randomness, that the historical data LTCM used to calibrate its models just didn't include periods severe enough to capture what was actually coming. The models assumed extreme, fat tail events were statistically negligible, simply because the specific historical data set they chose to look at had excluded those extreme events in the first place. The model wasn't a perfect representation of the real world, it was just a perfect representation of a limited, very comfortable history. And here is exactly how fast that limited history caught up with them. This timeline tracks the rapid 6-week collapse. On August 17, 1998, Russia defaulted on its debt. And this triggered a massive global panic, a huge flight to quality. LTCM had positioned themselves in lots of supposedly independent asset classes. But suddenly, because of the sheer panic, every single one of those independent assets moved together simultaneously. The correlation went to 1. And because of that, as you can see on the timeline, the fund lost an unfathomable $4.72 billion in just 6 weeks, culminating in that desperate Fed rescue. But, a mathematical model being wrong doesn't usually threaten the entire world. This number, however, does. 27-1. That is the staggering leverage ratio LTCM was allowed to carry by major banks. They were managing $126 billion in assets on a tiny, tiny sliver of actual equity. And the major banks, we're talking Goldman Sachs, Merrill Lynch, JP Morgan, they could see this completely skewed balance sheet. They had full visibility. But they just kept on lending to LTCM anyway. Which begs the question, why on earth would 14 major banks keep lending to a highly leveraged fund without checking the math? Well, this quote from the April 1999 President's Working Group on Financial Markets gives us the smoking gun. No one had independently stress-tested LTCM's models against a correlation to one scenario. Nobody checked what would happen if all the independent variables failed together. Why? Because reputational credibility completely substituted for actual independent model validation. They had Nobel laureates running the show. The credentials literally became the risk check. And this brings us right to systemic contagion. When the Federal Reserve intervened that weekend, it actually wasn't to save LTCM. It was because they discovered, in real time, that LTCM's supposedly independent disconnected trades were actually one massive interconnected bet distributed across the entire global banking system. The banks thought they were managing separate, isolated pieces of risk, but they had all plugged into the exact same underlying unstress-tested model. If LTCM fell, the whole system was going to trigger like a giant line of dominoes. Yet the cognitive dissonance here was just staggering. Even a full year later, in a 1999 Wall Street Journal interview, Myron Scholes was still defending his model. He insisted the model was right. The extraordinary event was outside anything reasonable to have modeled. Even after a catastrophic, interconnected failure that nearly broke the global economy, the assumption that the model was infallible held firm. Let's move to and see how this builds into a structured understanding, using the 5 Whys framework straight from our source analysis. 1. The model broke because correlations simultaneously went to 1. 2. Why? Because their historical data excluded extreme events. 3. Why didn't they catch it? Because Nobel credentials made it socially impossible to internally challenge the model. 4. Why didn't outside banks catch it? Well, counterparties trusted those same credentials over independent validation. And 5. Why? Because there was absolutely no structural requirement for third-party adversarial model review. A total lack of adversarial testing was the absolute root cause of the whole shebang. Now, we are going to execute a hard pivot. Because the reason we're analyzing 1998 in this explainer today is that enterprise project managers are making this exact same mistake right now. The correlation to 1 error isn't just an old finance problem. It is currently the biggest, most dangerous blind spot in how we manage interconnected AI tool stacks right now in 2026. And this brilliantly illustrates the exact danger we face today. In 1998, the ultimate risk check was a Nobel Prize credential. Nobody checked the math because the creators were famous geniuses. Today, in 2026, our ultimate project check is an AI vendor compliance certificate. We blindly trust that because an AI agent comes from a reputable vendor with a nice, shiny stamp of approval, it doesn't need to be independently stress-tested for how it interacts with the rest of our software. We are literally substituting a piece of paper for genuine verification, just like they did 20 years ago. Let's look at the modern AI stack interaction risk detailed in our case study. Just like LTCM's financial models, your AI models are calibrated on limited historical data. When conditions shift, like, say, a new regime change or a sudden market disruption, the correlation assumptions fail. You might have 10 supposedly independent AI tools running your customer service, your supply chain, and your compliance. But if they all rely on the same underlying inputs or cloud infrastructure, a single disruption will cause them all to fail simultaneously. The correlation goes right to 1. In fact, this exact interaction risk is why regulators have just started requiring companies to map these interconnected AI dependencies. So what's the crucial point here? The mitigation our case study points to is mandatory adversarial testing. We absolutely cannot rely on historical data alone. You have to deliberately force your interconnected AI systems into conditions they haven't been trained on before they ever meet them in production. You have to stress test the entire stack together. This cannot just be a nice-to-have checklist item. It absolutely must be a mandatory step in modern AI governance. Which brings us to the final thought you need to take away from this explainer. I want you to walk into your very next planning meeting. Look at 2 AI tools that were approved separately by different teams and ask this exact question. What happens if all our seemingly independent AI tools fail together? If your input data turns out to be completely wrong simultaneously, do your tools fail gracefully or do they trigger a cascading interconnected collapse? If you can't answer that question right now, well, you might just be setting up your own $3.65 billion weekend. Thanks so much for joining me on The Explainer, and I'll see you next time.